Morning everyone, my name is Pádraig Burke, Head of Tax at PwC Ireland, and I'm delighted to welcome you to today's Finance Bill webcast. Yesterday the Finance Bill was issued, probably the most exciting day of the year for tax professionals. Last week we had the budget, which gave us all the highlights, and now we have the detail, and as tax people we love the detail. I'm delighted this morning to be joined by three of my colleagues to chat through what it means for everyone. Firstly, Alma de Bruin, an International Tax Director, Stephen Rowan, our tax partner, head of our Technical Solutions Group, and finally Laura McKeown, a Financial Services Partner, who will help us bring us through the changes. Firstly, Alma, maybe some of the highlights from your perspective.
Yes, I suppose, Pádraig, one of the highlights from a corporate tax perspective has to be the increase in the R&D tax credit rate from 30 to 35%. I see this as a real clear signal of continued support from the government for innovation, and certainly a very welcome update. Something that came as a bit of a surprise was an update to Section 291A and specifically balancing allowances. That was introduced as part of the budget last week, and that update was to extend the 80% cap on IP allowances to balancing allowances for IP disposals that occur on or after the 8th of October. And finally, with Pillar 2 filings just around the corner, the first filings being due by the 30th of June next year, there were some Pillar 2 updates introduced by the Finance Bill yesterday, and they are certainly worth a mention.
Stephen.
Yeah, I think the standout area, Pádraig, from my perspective is the participation exemption on foreign dividends. Some changes have come through there with a view to making the relief a little bit more user-friendly and to address some of the problems, I suppose, in terms of accessing their relief. While the changes are welcome, I would say it's still a very complex relief in order to apply, and because of the 3-year or 5-year look back, depending on when the dividend is paid, that does still involve a lot of complexity and a lot of work in order to get comfortable that the relief does apply. So significant care is still required. We still await a branch exemption, expect that to come through in Finance Bill 26. And then in terms of other areas, the Finance Bill gives effect to a number of budget measures around climate change and property and so forth, as well as the changes that have been well flagged in the budget in terms of revised entrepreneur relief and the extensions to the SARP and foreign earnings deductions reliefs as well.
Thanks, Laura.
Yeah, on the whole, Pádraig, I would say from a financial services perspective, the measures are evolutionary as opposed to revolutionary, I would say. And what I mean by that is the measures themselves in isolation are not significant, but I think when you look at the whole tax package across the FS space, that's including the enhanced suite for product suite for asset management, some of the changes which Alma will touch on around kind of the R&D and the IP incentive regimes, and as well as some enhancements to our repatriation relief in the SARP. I think it definitely signals a direction of travel to a more competitive landscape here. So obviously we definitely feel that there were some missed opportunities, of course, and we'll touch on some of those aspects in the context of the aircraft leasing space, but I think in the round very positive from a financial services perspective, and plenty of good news in the bill this year.
Great, thanks. Before we get into detail, just to remind people, there's a Q&A box at the bottom of the screen. If you have any questions, please put them in there and we'll try and deal with them at the end. Alma, just turning back to you and the R&D changes you talked about. Maybe you can go into a bit of detail on them.
Yeah, so Pádraig, at the start there I mentioned the increase in the R&D tax credit from 30 to 35%. I mean, if we think about our R&D tax credit when it was first introduced, 25% rate that has now increased to 35% over the last few years. We've also seen other changes to the R&D tax credit regime in the form of ensuring that our regime is aligned with the OECD Pillar 2 rules, making it a qualifying regime. And I think by pairing the increase in the rate with international compliance, we have a really strong R&D regime that both rewards innovation and invites long-term investment. Just to touch on some of the other measures that were introduced to the R&D regime, there was a really welcome update in the form of the increase of the first year minimum payment threshold. So that went from 75,000 to 87,500. What does that mean? Well, I think for those that maybe have smaller R&D claims or those who are claiming their R&D tax credit for the first time, this is a real cash boost, because what it means is that you can actually get that 87,500 as a first year cash refund for R&D. So a nice little boost to cash flow. I would say overall the updates to the R&D tax credit regime are positive. They align with some of the positions that we, PwC, had outlined in our submission to the R&D public consultation last year. And the other point that I would refer to that the Minister announced last week was the notion of an R&D compass. So we'll get a bit more detail on that in the coming weeks, but effectively what that compass will do is it will consider some targeted changes to the R&D tax credit regime to better align it with industry practice. And what I mean there is, to ensure that it's taking into account the likes of outsourcing and the actual definition of qualifying expenditure from an R&D perspective. That compass is also going to set out a pathway for development of more innovation support. So I think that's certainly really something to watch out for. I think overall, our R&D tax credit regime is probably a best-in-class regime in terms of acting as a real incentive for businesses to invest in Ireland, both domestic businesses and international businesses. And I suppose we look forward to seeing a bit more detail on that compass in the coming weeks.
Great, thanks, Alma. And he then talks about unexpected changes in Section 291A. You might talk about them for a second.
Yeah, so I suppose the change that was announced in the budget last week was certainly one that was unexpected. And for those of our viewers this morning who avail of Section 291A allowances on certain qualifying intangible assets, they'll be familiar with the mechanics of that regime, and I suppose specifically the 80% cap on the amount of IP allowances that you can claim against your IP profits. So prior to last week, that 80% cap didn't extend to balancing allowances. So balancing allowances being the allowances that arise on IP disposals, where you might be disposing of IP and your proceeds are less than the allowances that you would get if you hadn't disposed of the IP. So that 80% cap didn't extend to those balancing allowances. But now, with effect from the 8th of October, any disposals or transfers of IP will be subject to that 80% cap on the balancing allowance. So effectively, that ring fences the utilisation of those allowances to the IP trade with the 80% cap. So I think for taxpayers that are looking at planning for IP disposals from the 8th of October, it's something to bear in mind, certainly in modelling around IP disposals. The last thing I would just refer to on 291A was there were some updates in the Finance Bill yesterday as well. One that's worth mentioning is some refinements to the regime to clarify how 291A applies in a scenario where you might have a transfer of IP between two Irish entities in the same group. So that's kind of a summary of what happened in terms of updates to 291A.
Right, thanks, Alma. Stephen, participation exemption and changes in the Finance Bill. What's in there?
Yeah, there's quite a number of changes which have come through to the participation exemption period. Let's take territorial scope first. So there's a slight change here. At the moment, the exemption applies to dividends coming in from EU, EEA and treaty countries. That's now extended to jurisdictions which impose a non-refundable withholding tax on the relevant subsidiary which is paying the dividend. And it applies with effect from 1st of January 2026. Small change, probably would have limited application, I would say, but welcome nevertheless. I think it's fair to say probably one of the main areas that has caused a lot of trouble in relation to the exemption over the past while has been the look-back period, this review that you need to do of the foreign subsidiary to see has it made any acquisitions of a business, part of a business, or the greater part of the assets of a business from a company in a non-relevant territory in the past 5 years. As I say, cause lots of difficulties. That review period has now been reduced down from 5 years down to 3 years. So that's welcome. Need to be careful with it as well, because The reduction down to 3 years only applies to dividends paid on or after 1st of January 26. So if you have paid or are paying a dividend between 1 January 25 up to 31 December 25, you still have to do a 5-year look back. So it's 5 years rather than 3 years until you get to 1 January 2026. In terms of other things, shareholdings, there's always been a question mark around, is a shareholding a business, a part of a business, or the greater part of the assets of a business? That's now been clarified and tidied up in the bill. So the position is taken in the bill that a shareholding is not a business or part of a business. It doesn't come into the reckoning in that 5-year, 3-year review that's need to be done. So that's very welcome, and that has retrospective effect back to 1st of January 2025. So very welcome. The other probably significant change has been when you are doing that 3-year, 5-year look back, what about acquisitions from Ireland? Again, this has been a thorny issue because foreign subsidiaries may have acquired assets from Ireland during that period of time, and Ireland was not a relevant territory. It's still not a relevant territory, but what they have done in the bill is clarified that an acquisition from Ireland does not give you a bad answer when you do the 3 or 5 year review. So that's good news, and that's a sensible outcome. In terms of one or two other things which have come through in the exemption as well, as you know, if you want to get the exemption, you need to be happy that the dividend which has been paid to Ireland is not deductible in any country outside of Ireland. And generally it's not. But one clarification or a clarification which has been made in the bill is to say that if a dividend is deductible for close company surcharge purposes or the equivalent in a foreign jurisdiction, that's not a bad thing. So if it is deductible for close company surcharge purposes, you're not knocked out of the exemption as a result. So that's welcome. And then finally, there's been a helpful clarification around countries that Ireland has signed a new double taxation agreement with. So previously doubt existed around countries that Ireland has signed a new treaty with, and there was a view that could be taken that a dividend from such a country would only be exempted 5 years after the treaty came into being. So the Finance Bill has now clarified that helpfully, and effectively introduced a deeming provision to make the country a relevant territory, such that dividends coming up from those countries with new treaties can qualify for the exemption in Ireland, assuming all the other conditions of the relief are satisfied.
And Pádraig, I might just jump in there just to, I suppose, from a financial services perspective, to say those changes and clarifications are very welcomed. I think across all aspects of the financial services subsectors, but most notably in the context of the asset management sector, where I think coupled with some of the changes that we'll come to shortly around the ability to repatriate up through a regulated partnership structure, that really is a significant step change, I think, for asset management, and in terms of our ability to kind of get a bigger share of the private assets market, and it's something that's been long asked for, included in a number of submissions by ourselves, even over the course of the summer, and I think it's a really good outcome.
Great, thanks Stephen and Laura. Just Stephen, if I was to use an old Fianna Fáil phrase, there seems to be a lot done, but is there more to do in this whole area?
Yeah, certainly a lot done, more to do. I think that's an appropriate phrase here. The changes are welcome, but they still leave a lot of practical challenges, a lot of difficulties that we need to navigate through in trying to determine whether the exemption applies or not. So firstly, we're still dealing with a 3-year look back. Still dealing with a case where we need to look at the foreign sub, see what acquisitions it has made within the past 3 years, and ascertain whether that gives a bad answer in relation to the exemption. And I would have a question mark as to, is the 3-year look back really needed at all? There are other protections there in the legislation. Also, in applying that look back, what about acquisitions, and acquisitions from seller companies where you don't know their tax status? So you have to be happy that you're acquiring it from a company resident in a relevant territory, and you may not know that in a seller group. There's also uncertainty over acquired assets. what are you acquiring? Are they a business? Are they part of a business? Are they the greater part of the assets of the seller's business? Again, very difficult questions to answer and very subjective in some cases. And also, with some foreign subsidiaries may have made very genuine commercial acquisitions over the past number of years, over the past 3 years at least. But depending what they've done and depending on what they have acquired, that may knock out the Irish shareholders from being able to access the exemption. So it's a real relevant trap there for the unwitting. I think probably more significantly as well is that there's no materiality and there's no proportionality in the rules. So even a very small acquisition of a business into a multi-billion-dollar company could throw you out of the rules, which is very surprising. And in terms of the ownership test, the 5% ownership test that the parent company in Ireland needs to have, that still needs to be done on a direct or indirect linear basis. We had hoped for a kind of a group attribution type rule similar to 66B, hoping that might come true in the bill, but that's not there, unfortunately. And also the territoriality is still a bit of a sticking point. There are limitations there, and the geographic scope could be extended further. But look, overall, I think what we have is better than what was there. I think for some groups who may have got a bad answer when they've done their analysis up to now, might want to look at things again, because it is just a 3-year review that needs to be done. Shareholdings don't come into the reckoning and Ireland no longer gives a bad answer. So maybe in those cases the analysis will be a bit more positive than it was. But also on a go-forward basis, I think an awful lot of care is needed in terms of dividends coming up from foreign subsidiaries. That foreign subsidiary will need to be kept under regular monitoring and regular review, and there probably will need to be protocols and guardrails put in place around that foreign subsidiary to make sure that it doesn't enter into bad acquisitions that could have the effect of throwing out the exemption going forward.
Thanks, Stephen. And Alma, turning back to you, Pillar 2, it's a big issue for a lot of companies. Any surprises in the finance bill?
Yes, I suppose the finance bill, what it does from a Pillar 2 perspective is really continues Ireland's implementation of the Pillar 2 rules to ensure that our Pillar 2 rules are aligned with the EU directive, the OECD model rules and the OECD's administrative guidance. So I would probably say most of the updates to Pillar 2 were expected, with some unexpected updates as well. Just to kind of briefly touch on some of the expected updates, one was the transposition of the EU's Directive on Administration and Cooperation. That's the 9th amendment to this directive. There's a lot of terminology being thrown around in a Pillar 2 world. So what does the implementation of that directive mean practically for taxpayers? Well, one of the things I think that it gives some clarity on is one of the filings that will need to be made by the 30th of June next year is a filing of what's known as a top-up tax information return under Irish legislation. So that return, I would see it as like a master return. It requires information about the corporate structure, any safe harbours being availed of, and the computation of top-up tax. That return in Irish legislation is called the top-up tax information return. People might be familiar with hearing it being referred to as the Globe information return, and that's what it's called under the OECD rules. So what the EU directive does is it provides a template for that return, where that return is going to be filed within an EU member state. If it's going to be filed outside of the EU, then the template that's followed is the Globe information return. So really, I think to put any confusion at ease here, it's the same return overall, slight differences in terminology used in the EU version. And the good thing is that groups will only have to file one of these returns. So I think the key benefits for groups in scope of Pillar 2 is the certainty that it brings. We know what information is going to be needed in that return by the 30th of June next year. The single filing approach obviously will also mean reduced administrative burden for in-scope groups. One of the other expected updates was the Finance Bill legislates for the OECD January 2025 administrative guidance. So our viewers will probably be familiar with the OECD issuing guidance on the Pillar 2 rules. The 5th set of guidance, which we saw in January this year, there was a suite of documents one of which was the Multilateral Competent Authority Agreement for the exchange of information relating to Pillar 2. So that's been in place. Ireland has signed up to it. And what that means is when you're filing that master return, the tax authorities will be able to exchange the relevant sections of that return with the relevant jurisdictions. The guidance, there was specific guidance released in that January update relating to specific deferred tax assets in a transition year for Pillar 2. So a transition year for Pillar 2 is that first year that you're within the scope of the rules. So what this guidance said is that for specific DTAs, and when I say specific DTAs here, I'm talking about DTAs that originate from certain governmental arrangements or originated from a new corporate income tax regime in another jurisdiction. So where those DTAs are relevant, they are excluded, and that update has been included with effect from the 31st of December 2023. Whilst that is somewhat a new rule, I suppose in practice we probably haven't seen it have that much of a material impact on Irish Pillar 2 taxpayers. One of the unexpected updates that was brought in as part of the Finance Bill yesterday was relating to the unwind of deferred tax assets that relate to losses. So from a Pillar 2 perspective, when you're looking at deferred tax assets relating to losses, you're looking at the makeup of the loss and whether that loss is a good or a qualifying loss from a Pillar 2 perspective. And a good loss from a Pillar 2 perspective is one that you can recast at 15%. So one of the questions that was arising from taxpayers was, if I have a loss and it's partially good and partially not good, how does that DTA then unwind? So the Finance Bill yesterday has provided some clarity on that. So in the round, I'd say from a Pillar 2 perspective, mostly expected updates. Unexpected, the one I called out there is probably the one most noteworthy.
Thanks, Alma. And turning to FS, Laura, from a Pillar 2 perspective, what are the main issues arising out of the Finance Bill?
Yeah, I think probably would echo all of the things that Alma has talked about in terms of, the FS impacted Pillar 2 groups. All of those points were welcome clarity. I think one incremental point worth mentioning is just the area around securitisation structures. So it's probably a bit of a minority sport, I would say, in the context of the broader Pillar 2 landscape, but it is very important in the public deal space within the FS sector. So the bill essentially clarifies, it's quite a technical point, but that orphan-owned constituent entities that are fully consolidated into an M&E group can be considered to be minority-owned constituent entities for Pillar 2 purposes. And that's really important because it allows essentially the entity to calculate its top-up tax and its ETR on a standalone basis. And there was some uncertainty around whether kind of those structures would fall into those provisions, and it's been a point of negotiation for some time. So clarity on that is really welcome by the securitisation sector in particular, I would have said. And the bill also does clarify that where you are a minority-owned constituent entity, that is also a securitisation entity, that you can essentially calculate your top-up tax on a standalone basis, but where a top-up tax arises, it then is moved under those provisions to entities within the group that are not securitisation entities. So it's probably worth saying that approach does align with our interpretation of the OECD guidance on this point, but given it has been uncertain, I think it's very welcome clarity in a sector where kind of the commercials and the legal aspects are really dependent on certainty from a tax point of view.
Great, thanks, Laura. And maybe just continuing on Pillar 2, Alma, you talked about the Finance Bill changes, but aside from that, Pillar 2, it's here, it's real. What are the main issues taxpayers should be looking at?
Yeah, it absolutely is here and very real. We're currently kind of looking down the barrel at the deadline for Pillar 2 registrations. So Pillar 2 registrations need to be done by the 31st of December this year for 31 December 24 year-end taxpayers. So to kind of stay in the vein of registrations, so the registration process has been open on Revenue's ROS portal since the middle of August. And so some points that I think groups should be really aware of in terms of registrations. So thinking about Irish in-scope entities, so each and every in-scope entity will need to register for at a minimum for the qualified domestic top-up tax, which is probably more commonly known as QDTT. And that registration is required regardless of whether you're expecting to be safe harboured in Ireland or whether you're expecting to calculate and pay a top-up tax in respect of Ireland. I think it's really important to note that the registration is done on an entity-by-entity basis, so there's no group registration facility. So for those larger groups with a large number of Irish constituent entities, each and every single one of those entities are going to have to be registered separately. And there's a lot of time that would be involved in doing that registration. I mentioned that the registration process is done on ROS. The process is like a click-through screen process. So there's no ROS offline form that you can complete and upload. You kind of have to go through the steps of an on-screen registration process. So again, that takes quite a bit of time. I think overall, the key takeaway from a registration perspective is the time involved is not to be underestimated. So strongly recommend actioning registrations now. Probably worth just mentioning, failure to meet the registration obligations does come with penalties, so something to be kept in mind as well. In terms of compliance readiness, so the first Pillar 2 filings are due, as I mentioned, by the 30th of June next year. So that deadline is fast approaching. So what do taxpayers need to think about in terms of preparing for that deadline? Well, that master return that I mentioned earlier, the top-up tax information return, that will need to be filed by the 30th of June. There are other returns as well, depending on your Pillar 2 profile. So there may be QDTT returns or self-assessments to be completed, income inclusion rule returns as well. So I think between now and the filing deadline next year, it's a busy period for groups because groups will be busy out towards the end of this year. Groups will be busy in Q1 next year. So I think now is a real opportune time to be kind of putting your hands around Pillar 2 and really being prepared for the upcoming compliance obligations. So what do you need to think about, or what questions do you need to be asking right now? So in terms of that master return, do you have access to all of the information that you need to complete that return? For top-up taxes, have you done the calculations? If you are expecting to qualify for the transitional CBC or safe harbour, have you done those calculations? Do you know if your CBC report is qualifying? These are all questions that I would really strongly recommend our viewers to act on now. And, do reach out to your PwC teams for support with registrations and compliance as well.
Thanks, Salma. Very comprehensive. Laura, turning back to you, you mentioned some missed opportunities in the leasing industry when you gave a quick summary at the start. Maybe you want to comment on that in a bit more detail, please.
Yeah, absolutely. I think that probably was a notable disappointment in the bill yesterday, particularly, as you said, Pádraig, for the aircraft leasing sector, and it's essentially changes which were made or proposed to Section 840A. And just by way of background, that's essentially a section which kind of denies a trading deduction for interest on intergroup borrowings where the proceeds are used to acquire an asset from a connected company. So it was an anti-avoidance measure introduced back in 2011 in fairly short order, and pretty broadly drafted legislation, and kind of captured a number of transactions which were somewhat unintended at the time. And I guess shortly after that, Revenue did move to issue an e-brief to try and clarify some of those things and counteract some of the negative impact, and essentially provided a carve-out for assets which were purchased for the use in a leasing trade, so that did kind of solve a lot of the market issues at the time. But as recently as last year, that e-brief was withdrawn without consultation with the industry. It's caused a huge amount of uncertainty in the market, and the sector has been heavily engaged with policymakers on this point. So I guess in some respects, change was expected. And, while there are some positives to what was introduced, and I'll go through the measures now, I think it fell short and maybe introduces a little bit more complexity than the sector would have hoped. But essentially, there is a carve-out where certain conditions are met from the application of this anti-avoidance, and that's really where the seller of the assets must have used the borrowed funds to previously acquire the asset, and must have received a tax deduction for interest prior to kind of the transaction in terms of transferring the asset over. The lender must have also been subject to tax on the receipt of that interest, either in Ireland, the EU, or in a double tax treaty jurisdiction. And then the loan must also have been made for bona fide kind of commercial purposes. So there's just a general kind of anti-avoidance provision around that. So I mentioned generally I think the carve out is welcome, but you know it doesn't go far enough, and when you get into the weeds, unfortunately I think there will be challenges in terms of the drafting. In particular, the carve out does introduce a cap, and it requires the buyer's deductible interest essentially to be capped by reference to the seller's principal outstanding on the seller's loan. So I think there's just a compliance burden aspect that will be introduced to this, and the fact also that the rules do appear to kind of maybe apply to transfers within 2024, so some retrospective review will need to be undertaken. But I think probably there's a bit of work to do in terms of, you know, digesting those provisions and different fact patterns over the coming days and weeks, and I suspect that as an industry there'll be heavy engagement on that provision.
And you talked about enhancements to the asset management suite we have here in Ireland coming in the finance bill. Maybe you want to touch on that for a second.
Yeah, so I think I referenced this earlier when Stephen was talking to the points about the participation exemption and the ability to have a fit-for-purpose holding company structure. I guess from an asset management perspective, the ability to repatriate up those profits from your holding company to your investors in a tax-efficient way is very important for kind of a collective investment vehicle that's typically tax neutral. So the changes that came in yesterday are very positive in terms of the enhancements which are proposed to the application of dividend withholding tax on payments to regulated partnerships. That's both Irish regulated partnerships, so the investment limited partnership, or an EU EEA equivalent structure. And essentially it puts the investment limited partnership, which was a revamped structure back in 2020, on a level playing field with the ICAV, which is our Irish collective investment vehicle, or our corporate regulated fund. And it really does, I guess, enhance the attractiveness of the investment limited partnership for certain strategies like private equity. And the rule essentially says that where the limited partnership holds more than a 51% interest in the underlying subsidiary, that there is an exemption there, and the ILP can just be deemed to be the beneficial owner for the purpose of making the relevant declarations and the paperwork that goes with it. So I would say a very positive development. There was a kind of public consultation on this earlier this year. I think the option that has come through in the legislation is probably the one that would have been pushed for by the industry and ourselves at the time. But the one point that I would note is that the rules do operate subject to kind of the application of the outbound payments rules. So I think it will be important, I suppose, to clarify some of the changes which came through in the Amendment Act earlier this year, and the read across to the guidance around widely held funds in terms of how those pieces of legislation interact with each other. But broadly, a very, very positive development, and as I said earlier, a step change in the context of the private asset structures that we can offer from an Ireland Inc. perspective.
Great, thanks, Laura. Stephen, other measures in the finance bill, we've touched mainly on a few of the bigger areas, but maybe bring us through some of the other changes that were in the bill.
Yeah, thanks, Padraig. So the various property measures that were announced on the budget day to increase housing supply, they are being legislated for in the bill. So there are things like the 9% VAT rate on newly completed apartments, the enhanced corporation tax deduction for apartments, the CT exemption for the cost rental scheme properties, and then various RZLT changes, stamp duty refund changes, and the Live in City initiative extension and enhancement in that space as well. So there's kind of a raft of property measures there. One thing to call out is just in relation to apartments. A number of apartment developments are subject of forward funding arrangements, and these are causing some difficulties in terms of accessing the 9% VAT rate and also the enhanced corporation tax deduction, as well as accessing some of the RZLT relaxations that are there. So we'll need to keep a watching space on this area, particularly as the bill passes through the Oireachtas over the coming weeks and months. I signalled on budget day as well, there are a small number of tax measures around incentivising the green energy transition, and these are mostly in the area of energy efficient equipment and vehicles, and the extension of the scheme that's there already. I suppose it is a little bit disappointing that there hasn't been more targeted policy measures in the green space or kind of in the renewable space. There's various tax proposals, for example, in the clean industrial deal, and it would have been interesting to see some of those applied or taken up in an Irish context. So, for example, tax incentives to encourage private investment in renewable energy, decarbonisation and the circular economy. Something could have been done in that area. The introduction of accelerated depreciation for clean technologies is something else. And also the expansion of the accelerated capital allowances regime to encompass a bit more in what's included in energy efficient equipment, I think probably would have had would have received a positive response. In terms of other things, the increase in the revised entrepreneur relief for CGT announced on budget day, that has come true, very welcome. And similarly, the extensions to the SARP and KEEP schemes, as well as the enhancement to the foreign earnings deduction, they've all come true as well. So positive on that front. And finally, a new provision has come through in the bill. Wasn't announced up to now, certainly not on budget day, but it confirms that a foreign body corporate and its members will be chargeable to tax on the basis that the foreign body corporate is a partnership where it is substantially similar to an Irish partnership. So we're still digesting this, still thinking about it a little bit in terms of the wider ramifications of this provision, but we think it's probably aimed at UK LLPs, which has been the subject of some discussions and correspondence with Irish Revenue over the past while. So we think it's probably geared in that particular direction.
Thanks, Stephen. And as we come near the end of today's webcast, Alma, just touching on you, we've spent a fair bit of time on Pillar 2 even. Pillar 2. We haven't got Pillar 3 yet, don't worry, folks. But if you were to pick out three kind of key things that, the listeners should remember and do, what are they?
Yeah, so I suppose I said a lot about Pillar 2. So if you remember three things: register early, do it now, finalise or maybe start your Pillar 2 calculations, and make sure that you're ready for all of the information and data that you need to gather to complete that master top-up tax information return ahead of filings last year. So be prepared.
Thanks, Alma. And Laura, from a FS perspective, you mean overall finance bill, good or bad?
I would say in a nutshell, good. I mentioned this at the start. I think the provisions in totality definitely have a positive impact overall. I should have mentioned also the rate change kind of in the context of retail investor participation in Irish funds, something that has been kind of, I suppose, signalled for a while, been pushed by the industry, aligns with the kind of savings and investment union at an EU level. So the rate there going from 41 to 38% is obviously positive, but I think it is disappointing that it didn't move to align with the CGT rate of 33%, that they didn't look to remove the 8-year deemed disposal rules. That's quite a clunky rule and, prevents, the accumulation of gains within the structure. Overall, I think it's positive. I do also think from a financial services perspective, some of the policy matters signalled by the ministers in the speeches around, particularly on budget day, around the roadmap for the Fund Sector 30 report into 2026, also the broader interest consultation, which we'll be moving into in the coming weeks. I think it's going to be really important as an industry that we continue to engage on these matters. We've definitely made progress, but, to coin your phrase, a lot done and more to do.
Thanks, Laura. And Stephen, our clients, people listening in today, what should they be watching out for over the next coming weeks and months? Yeah,
so yesterday we saw the finance bill as initiated, and just a small plug for the PwC client bulletin, which issued this morning. I think that's a great reference point for people as well. There's a lot of great content in there. I think over the next few weeks, what we'll see is the committee stage and the report stage amendments to the finance bill. And I'd say that's an area to watch closely, because sometimes there can be key changes coming through at committee stage or report stage, and sometimes there's anti-avoidance measures that come through as well. Next week in particular, there will be various meetings with Revenue through the talc forums, fora, to talk about the finance bill measures. And obviously, if clients have any areas that they would like to feed in to those, please reach out to us and we'll be happy to take them on board. The Tax Solution Centre will be hosting a tax briefing probably in late November, early December, where we'll cover the various aspects of the bill, and in particular the significant changes to the bill since its initiation yesterday. And then in early 2026, we'll have revenue guidance on various aspects of the bill. Laura's touched on there a second ago in terms of the action plan for interest reform, so that's obviously a key area to keep an eye on as well. That action plan was announced on budget day. Obviously we had an open consultation in 2024. The first phase of the new plan is going to focus on the taxation of interest and the deductibility of interest. And what we'll see in terms of output on that is a feedback statement in November, so next month. Then an outline of the legislation is earmarked for April, and then the legislative changes due to come through in Finance Bill 26. So a lot going on in that particular area and very significant developments. Generally a lot to come here in the next few weeks, next few months, and a lot leading into next year's Finance Bill as well.
Great, thanks, Stephen. And just before we finish, it's always good to look back. And we made a pre-budget submission before the budget in the summer. You know, one of the areas we touched on was trying to bring some simplification to private business. Did we see anything in the budget or the Finance Bill in relation to that?
For private business, probably not particularly, I would say. We see simplification coming through in the form of the participation exemption to align it with the policy objective of being a simple and straightforward relief to apply. And there's also some steps towards simplification of interest, as I just mentioned. But in fairness, they're probably all directed towards large groups, large taxpayers, large corporates. For private business, probably a little bit disappointing that we haven't seen any kind of gear change there, and the compliance burden probably still remains the same as it is at the moment, and the compliance burden for large corporates is generally the same as it is for private business, so there's no distinction there. It's still the same corporation tax return that needs to be filed, and still the same rigour within R&D that needs to be worked through. So no major gear change, unfortunately, around simplification.
Thanks, Stephen. And the stat I'd like to put out is 25% of large companies claim the R&D credit, yet only 3% of small companies. And one of the reasons is the cost of actually putting the claim in, and they need to do something about it.
Yeah, absolutely.
And thanks, Stephen. Alma, for the FDI industry, was there anything there to attract new industries?
Not particularly, Porrick. I suppose if you think about it from the perspective of Ireland as a location for attracting foreign direct investment, I think we could have done something for some of the new emerging technologies. I mean, the obvious one is AI. We see so much AI being used. It's very prevalent. So I think maybe something could have been done there, maybe around the introduction of like accelerated capital allowances. We probably also could have done something around some new incentives for brand intangibles. So, I think it's an opportunity. We need to be ensuring that our rules and our attractiveness as a location for foreign direct investment, that we continue to kind of progress almost at the same speed that these new emerging technologies are appearing before us.
Absolutely, completely, Alma. And I suppose from an FS perspective, what was on the wish list that maybe didn't come through?
Yeah, I think Alma's comments there resonate with a lot of FS taxpayers. I would say if I look back to some of the pre-budget submissions that we made, a couple of things we asked for were targeted measures around the whole area of sustainable finance and, helping to support our flourishing fintech industry. I think arguably some of the measures that we talked to today in the round are supportive of these things, but I would like to see a more ambitious and targeted action plan to really look to position Ireland as a hub for some of these things. I think when you look to the infrastructure that we have here and how competitive it is in the international environment, I agree we really need to kind of be progressive in our thinking and have more targeted measures to attract some of these areas into the Irish market.
Thanks, Laura. And with that, I think we'll end today's session. Thanks to Laura, Stephen and Alma for their contributions. I'm sure you'll agree, very insightful. If you do want more detailed analysis, please log on to our website at pwc.ie, where, as Stephen says, our detailed finance bill released there is on there, and it's worth a look. Like a good John Grisham novel, it's a real page turner. Now, if you look forward, and like me, you're a bit of cold turkey after finance bill came out yesterday, you've nothing today. As Stephen said, we've committee stage amendments, report stage amendments to come, and remember, it's only 364 days to next year's finance bill. Good luck and have a nice day. Thank you.